Masternodes versus index funds, or simply put, crypto passive income versus traditional finance. Which one is a better vehicle for making money?
Crypto, obviously, right now getting crushed.
Bitcoin hitting its highest level in about 2 months.
Or so Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
To answer this question, I have the data compiled on 4 top index funds and crypto nodes that are arguably the most safest and consistent way of making passive income in each sector. And we'll be looking at the pros and cons of each, as well as how they rank in 6 different categories. And by spending just 10 minutes watching this video, you're going to be able to make the best decision on how to turn a modest savings account into a life-changing nest egg that will print money while you sleep. And stick around until the end, because I'm not only saving my favorites for last, but I'm saving a bonus method as well. An index fund is an investment fund that follows a market index. This means one purchase in a particular index gets you access to all of the investments in that portfolio. For example, if you want exposure to some of the top stocks, you might go into the S&P 500, which is an index fund that's comprised of the top 500 companies in the United States. Or let's say you just wanted to focus on tech companies. You could get the Vanguard Growth ETF. And ETFs and index funds are almost the same thing, with one key difference, and that's when you can trade them. And as a shareholder in an index fund, some of those stocks are comprised of companies that pay out dividends when the company profits. And those dividends can be paid out monthly or quarterly, depending on the type of fund it is. But the key word is some, because not all companies do this, but you can still make money by the appreciating asset of the index fund itself, which is where the majority of the money will be made. Masternodes, on the other hand, are entirely different. Out of the 20,000 cryptocurrencies right now that exist, some operate on a system called noding. And these are independently ran servers or computers on the blockchain that store and secure transactions and relay information, which is essential for the blockchain to function. And because running these nodes is necessary, incentivization is needed, so they pay out yearly, monthly, or sometimes even daily interest. And there are a couple of different types of nodes. There are just regular nodes, and then there's a special type of node called a masternode or a validator node. And masternodes usually require a larger starting balance to partake in, and they have more authority than regular nodes as well. If you're hosting a validator masternode, not only are you going to earn a fixed interest, but when people come stake their tokens to use your validator, you can earn interest from them as well. For our first index fund, let's look at the Vanguard Total Stock Market Index Fund, or the VTI. This index fund tracks the return of the US stock market, which includes everything from large to small cap stocks. This means that for under just $200 a share, you can gain exposure to the entire stock market. The index holds over 4,000 different stocks across multiple categories, and the average 10-year annual return is at just over 12%, with a dividend payout of just over 1%. And when it comes to gaining access to any of these index funds I talk about today, it's relatively easy to do. You can hit up almost any accredited institution and they'll have access to these. I personally use Franklin Templeton. But let's take a look at our first node. First up is the Ethereum validator node, and it's the most expensive node on the list. With the current price of Ethereum being $1,500 and having to stake 32 Ethereum just to be a part of the validator, that means the cost to partake is just under $50K. However, that's just the cost of the coins. When investing in any validator, you have to account for the costs as well. Because it's going to have to be kept active 80% of the time in order to receive those rewards, it's going to require Wi-Fi and power. But there's a company called Avato that sells these very small, quiet devices for about $1,500, and you can run all of the nodes that I talk about today on this one device. The payout on an Ethereum validator varies, but right now a safe bet is around 5%, or about $2,200 per year at current price points. And it's worth noting that your node might get some unburnt Ethereum from transaction fees, but that's yet to be announced. There isn't a 10-year return on Ethereum since it was created in 2016, but it's appreciated by about 1,200% since March of 2020. Next up, let's talk about REITs, which is short for Real Estate Investment Trust. These are real estate funds that produce income that they share with their shareholders. One that I really want to highlight is the Vanguard Real Estate Index Fund, and this index fund tracks the return of the U.S. investment market of the 2550 index. And this index invests in REITs for you and shares the returns on over 171 individual REITs. There's an entry cost of $92, and it has an annual 10-year return of 7.5% with dividend payments of 3.5%. This means that per $10,000 you invest, you get about $350 $50 per year in dividends. The next validator on the list is Avalanche or AVAX. You'll need a minimum of 2,000 AVAX tokens for collateral, which costs about $19 each. So that means a validator node for AVAX is just under $40,000. There are over 1,200 active nodes on the network. And the reason why we need to know this is because the more nodes active there are, the more those rewards have to be split up. Right now, the average return on an AVAX validator is about 9% per year. You can also get those fees from people staking on your node, which can range anywhere from 2 to 10%, but you're guaranteed 180 AVAX tokens by end of year, which is about $3,400. It's also worth noting that AVAX has a minimum staking period of 1 year, and it has one of the most aggressive burn programs in crypto. The project has only been around since 2020, but since July 2021, the project is appreciated by about 50%. Now, our third index fund is one that's a bit higher paying, and it's the Schwab US Dividend Equity ETF. And this index, or ETF in this case, tracks the return of the Dow Jones US dividend. And this measures the high performance of high dividend yielding stocks in the US that have consistently paid dividends over the years. The index holds 104 dividend paying stocks, including PepsiCo, Coca-Cola, IBM, and Pfizer. And at $72 a year, the annual return on this index is just over 13%. And it has a dividend yield of just under 3%, meaning that if you were to invest $10,000, you would receive a $300 yield. And since 2011, this ETF has appreciated by almost 300%. Now, moving back to nodes, let's look at Flux nodes. Flux is a decentralized cloud infrastructure that lets users and projects use their cloud storage and facilities, and it's aiming to compete with Amazon Web Services. Now, there are 4 different tiers to Flux nodes. The higher you go, the higher the buy-in cost gets, but the higher your rewards are. The lowest node, or the Cumulus node, is 1,000 tokens, which costs just under $1,000 right now. And the average return on this base node is about 11%, not including the cost of running the node. And since 2021, this token has appreciated by almost 4,000%. And for the fourth and last index, I want to talk about the Vanguard Information Technology Index, or the VGT. And this index specifically tracks the performance of information and technology stocks in the US. It includes almost 400 stocks, some of them including Apple, Microsoft, and Visa. And it starts at $340 a share and has an average 10-year annual return of just under 19%. The dividend yield on this one is just under 1%, but because of the high annual return, it's one of my favorite ones out there. And the last and one of my favorite nodes on the list is the Phantom Validator node. And this one is down substantially in price right now, but it still costs more than an ETH validator. And in order to get a Phantom Validator node, you need 500,000 Phantom tokens, which costs about $120,000. But because there are only 76 validators on the network right now, the return is over 14%, which comes out to be over $17,000 per year at the current price Phantom's at. And when looking at index funds and masternodes across these categories, you can see that index funds are much safer and easier to access. However, when looking at the 10-year returns on these masternodes, they're going to be much greater because you're assuming more risk. However, if you want a cheaper node to look into to run, there's one called Presearch that has a 28% yearly return, and it rewards people in crypto for using their internet browser, and it only costs $280 to get into. And there are entities out there that do something similar to index funds where they create exposure to a lot of different nodes by just one buy-in cost that doesn't cost that much money, whereas some of these nodes are costing $10, $20, $100,000, and the monthly returns can be anywhere from 2 to 10%. So if you're interested in that, check out some of my other videos on masternoding right here.